Good afternoon, boys and girls. It's a Liberty Call for Tuesday, March 22nd, 2022. I just looked at the date before I hit the start button, and I can never remember it. I have the short-term memory of a fly, but I can remember stuff from 30 years ago, which is crazy. Anyways, I'm Raymond Dahlman. I'm your humble host here today. If it's your first time watching, you can click on one of those subscribe buttons over here and give me a thumbs up. And maybe send it off to a friend or a family member who would get some value out of my ramblings. I try to make this entertaining and informative at the same time. So, all right, well, let's go ahead and jump in and see how the markets did today. Bump that up a little for you. All right, the Dow Jones was up 0.74%, closing at 34,807. S&P 500 up 1.19%, closing at 4514. NASDAQ up 1.95%, almost 2% today, up at 14,108. Small caps are also up 1 1/3. The VIX was down 2.5%. It's at 2294 right now. Let's take a look at the other indexes here in the Americas. Canada was slightly up. Brazil was up almost 1%. Mexico up 0.5%. All right, let's take a look at the European indexes. Germany up 1%. The UK up 0.5%. France up 1.17. The Euro Stoxx up 1.14. Netherlands up 1.38. Yeah, green all the way down. Let's see, this one was up 2%. This is the Portugal exchange. The only red I see is Denmark. They were down less than 1%. Russian exchange is still closed. The other Eastern European exchanges, they were up. Getting into Asian markets, Japan was up 1.5. Australia was up 0.86. New Zealand down slightly, 0.17. The Chinese markets fairly flat, except for the Hang Seng. It was up 3.15%. And green all the way down. Pakistan, their market was down 0.06. So for trading day, March 22nd, looked pretty good. All in all, I think, at least here domestically, we're, taking kind of a breather after the rate hike. And, folks are trying to figure out where things are headed over the medium term. So that is certainly some good news. All right. Let's take a look at some articles. Let's make that a little smaller. All right. This market recap here. S&P 500 takes an aggressive Fed rate hike. Bets in stride. Written by Yassine Ibrahim. The S&P 500 jumped sharply as investors piled into big tech, shrugging off an ongoing rise in yields amid growing expectations for the Federal Reserve to turn more aggressive on rate hikes. Glad to see people are warming up to that idea. Federal Reserve Bank of St. Louis President James Bullard stressed the need for the Fed to move faster and more aggressively on rate hikes to curb the pace of inflation. That's a good idea. The remarks arrived a day after Fed Chairman Jerome Powell said the central bank would be prepared to hike by more than 25 basis points at upcoming meetings to ensure a return to price stability. Wall Street was quick to price in steeper hikes following Powell's comments, with Goldman Sachs now forecasting a 50 basis point rate hike at the Fed's May and June meetings. So that'd be good. We'd be up a full 1% from where we are right now today by June. Regional banks pared some of their recent losses, helping the broader financial sector to rise more than 1% as rising rates boost the net interest margin of banks. SVB Financial, Wells Fargo, and First Republic Bank led the move higher. Growth sectors of the market, including tech, didn't waver under pressure of rising yields. Meta Platforms, Amazon, Microsoft, Alphabet, and Apple climbed more than 2%. Chinese tech stocks were also in the ascendancy, supported by a surge in Alibaba Group after the e-commerce boosted its share buyback program to a record $75 billion. JD.com and Pinduoduo also rose on Tuesday. Tesla, meanwhile, jumped more than 5% after the electric vehicle maker officially opened its Gigafactory in Berlin. The move is expected to boost Tesla's market share in Europe. The opening of the Giga Berlin should further vault its market share within Europe over the coming years as more consumers aggressively head down the EV path. end quote, Wedbush said in a note on Monday. On the earnings front, Nike, a sizable Dow index component, rose more than 3% after reporting better than expected quarterly results. Quote, recent results and commentary from leadership of the company showed clearly that Nike is managing well various external headwinds, including ongoing supply chain disruptions and geopolitical tensions across the globe, end quote, Oppenheimer said in a note. Quote, we are optimistic that money will soon flow back into Nike shares, end quote. Energy stocks gave back some of their gains from a day earlier as oil prices turned negative, but losses were kept in check by fears of an oil supply shortage as the European Union mulls joining the U.S. in banning Russian oil. So, pretty good day from the daily perspective. Long term, I certainly am more pessimistic on where things are headed over the next few months or even a couple of years. Just depends on the powers that be, how they handle this with the Fed, with our government, with their ridiculous spending. So I really don't have high hopes for where things are headed right now. All right. This was a pretty funny little, let me blow this up so you can see it. This comic of the week, the pain of high gas prices. And the different octanes are Dom Perignon, printer ink, and he's getting unicorn blood to put in his in his car. So let's. I'm not going to read this whole thing, but this focuses more on the European situation. What happens when an economic necessity becomes a luxury? Europe is at its wits' end trying to square the circle. To put pressure on Vladimir Putin to stop his assault on Ukraine, it needs to stop sending money in return for oil and gas imports. But if oil and gas imports stop, then the European economy will collapse. Governments all across Europe are scrambling to find ways to ease pain for consumers who are facing record costs for motoring, and with good reason. High fuel prices can quickly bring social instability, as refinery blockades in the UK and Yellow Vest movement in France have proved within the last few years. Given the extreme emergency facing Europe right now, it cannot afford such distractions. Last week, gasoline prices in Europe ranged from as little as $1.46 a liter in Poland to $2.26 a liter in Germany. That's the equivalent range of $7.36 to $11.38 a gallon. Woo! That's like almost 3 times the price of premium here. So any U.S. drivers feeling miffed at record high gas of $4.25 a gallon might want to bear in mind that during the early stages of the pandemic, when crude prices briefly fell below zero, German gas prices bottomed at $5.90 a gallon. There's a one-word explanation for that difference: tax. Taxes can account for anything up to 75% of what European driver pays to fill up their tank, the result of years of policy making that has tried to incentivize fuel efficiency and the use of public transport. That means there's plenty of scope for government action to make a difference. A raft of cuts in fuel duty are consequently coming down the line. France has said it will cut 15 euro cents off a liter of duty on gasoline for the next 4 months. On Wednesday, UK Chancellor of Exchequer, I have no idea what that word is, Rishi Sunak, is widely expected to announce a similar time-bound 5 pence per liter cut in duty, while Italy's Prime Minister, the former European Central Bank President Mario Draghi, intends to cut fuel duty by 25 cents per a liter for 1 month. Wow, such nice people. The French and Italian cuts alone are bigger than the entire gasoline tax usually levied by the likes of Maryland and Georgia, 2 states which have suspended collecting the tax while prices are so high. It's the same situation in other states such as New York and Illinois, which are also considering similar measures. In Germany, Finance Minister Christian Lindner has proposed a rebate system which would see the government reimburse retailers for cutting pump prices. His coalition partners, left-wing Social Democrats and Greens, who tend to drive fewer gas-guzzling SUVs, don't like the idea, but have yet to come up with anything better. So yeah, you thought our taxes here in America were rough on gas prices. I mean, that's outrageous. So see, that's the problem with using taxes as a punitive measure. It's kind of like the smoking, the taxes on cigarettes. I know cigarettes are bad. I haven't smoked a cigarette in probably a decade. So being a good boy, I've been using my vaporizer for 10 years. Haven't Haven't put one of those cancer sticks in my mouth since. But, using punitive taxes to try and, shift behavior, that's all you're doing is robbing people, especially for cars. I mean, you got to be able to get around. I mean, I live 20 miles from a gas station or a grocery store or anything. I mean, I got to drive past tons of cows and horses just to get to civilization. So, it just doesn't make a lot of sense to punish. And also, I drive a big truck because I tow stuff with it, and it wouldn't make a lot of sense to have a little Prius. I couldn't pull my fifth wheel with that. So, anyways, get off my high horse about that. Next article has to do with the Fed. That just seemed, there's been a lot of articles out there regarding what the Fed is. Now they're hinting at, we're going to do 50 basis or 0.5% rate hikes. Should have been doing that last year. And this is very similar to the last 3 or 4 months. I mean, really going back to around Thanksgiving when, all we would see is, the Fed's going to raise interest rates at their March meeting. So we had a 3 or 4 month window to, I guess, get comfortable with the idea. We're really going to do it this time. If inflation doesn't fall back, we're really going to raise interest rates. And, they get to March and, inflation is as bad as it's been. So they had to actually stick with it. So I think we would have probably gotten a 50 basis point rate hike if we hadn't had all the Russia crap going on the last 30 days. But, take the wins where we can get them. All right. Excuse me. With inflation and growth concerns swirling over the markets, Jerome Powell dropped a tantalizing clue on Monday about how the Federal Reserve will approach its next rate-setting meeting in May. They to have spotted the sign, you'd have to be a top-notch Fed jargon parser. In his speech yesterday, Powell added a new adverb, expeditiously, to his vocabulary about how aggressively the central bank could hike rates this year. He also signaled being open to 50 basis point rate hike, but also closing the door on a 13-year stretch of loose monetary policy and rock bottom lending rates. Wall Street pounced on Powell's speech with a series of new bets that the Fed will be even more hawkish than previously thought. Our best guess is that the shift in wording from steadily in January to expeditiously today is a signal that a 50 basis point rate hike is coming, in quote, Goldman Sachs chief economist Jan Hatzius wrote in an investor note, quote, we now forecast 50 basis point hikes at both May and June meetings, followed by 25 basis point hikes at the 4 remaining meetings in the back half of 2022, and 3 quarterly hikes in 2023, Q1 through Q3. Add that up, and the federal and the benchmark federal funds rate could be above 3% in 18 months' time. That's awesome. Not good news for aspiring home buyers or people who have variable rate mortgages. Well, yeah, it's going to suck for them, but unfortunately, we're going to have to take a step back in home prices and home building. And I mean, if you can pay cash, great. But if you're hoping to be able to get that no money down, super cheap mortgage, I think that window is pretty much. I mean, still rates are still going to be fairly low. I remember my first mortgage back in 1998. God, it was probably 7%. And I mean, we had, awesome credit scores. I mean, that was a very good rate at the time. And then 5 years later, we bought a house in San Antonio. And I think we were probably in the 4 to 5% rate range. And then anyways, you don't care about my home buying history. But, these are still going to be good rates. It's not, I don't anticipate that the Fed will go as far as Paul Volcker did in the early 80s and jack rates up into the teens. But I mean, it's certainly a possibility. So might have to wait, a little bit of time or save up money and, put down large down payments and buy down points and things like that to be able to afford it. So, all right. The Fed's aggressive ramp up in rates is looking like nothing we've seen in recent years, noted Jim Reed, Deutsche Bank Global Head of Thematic Research, a sign the central bank feels it's behind the curve in keeping inflation running at a 40-year high in check. It's increasingly dawning on investors that this is going to be a very different hiking cycle from its predecessor back in 2015. And yesterday, Fed funds futures moved to price in more than 200 basis points or 2% worth of hikes in 2022 for the first time, including the 25 basis points we saw last week, in quote, Reed wrote on Tuesday. Following the Powell speech, the 10-year or the yield on the 10-year Treasury note jumped 14 basis points on Monday, and equity sank in afternoon trading. U.S. futures are doing a bit better on Tuesday, with the S&P up 0.4%. European bourses were in the green at the opening as well, as most risk assets were rebounding. Crypto prices, for example, were gaining, with Bitcoin up to 42,500, an increase of more than 3% in the past 24 hours. Investors are taking heart that the closely watched spread between short and long-term bonds, measured as the difference between the yield on a 2-year Treasury note and the 10-year Treasury note, has been widening in recent weeks, a signal that Wall Street sees the chance of a recession is on the wane. I wouldn't bet that. I wouldn't go that far. I think we're severely due. We avoided recession 2 years ago by pouring $4 to $6 trillion into the economy 2 summers ago. So, eventually that steam's going to run out, and we're going to have to deal with that. So, all right. Next article. This is pretty scary. Fertilizer prices just hit a record high, sparking fears of global starvation and the worst food insecurity level since World War II. I've been hearing a lot about this. I mean, really going back 2 years ago with the shutdown. And there's a podcaster I listen to. It's titled, his podcast is Ice Age Farmer. And he pays attention to all the stuff, from food being shipped around the world to fertilizer. I mean, all the stuff is, from growing food to getting it, into your stores. This guy stays on top of it, and he's been worried about this for quite a while. So, and then you pile on top of that the Russia-Ukraine issue, where, in this article outlines, why that's a big deal. So let's go ahead and jump into this. Farmers worldwide are feeling the stings of sanctions as the Ukraine war has sent fertilizer prices soaring to new all-time highs, prompting concerns over a global food shortage. Fertilizer prices last week were nearly 10% higher than the week before, according to Green Market's North American Fertilizer Price Index, the highest price point ever recorded. Prices are now 40% higher than a month ago before the invasion of Ukraine. The surge in fertilizer prices reveals how dependent many of the world's farms are on Russian exports. Countries already afflicted by food insecurity now risk further production bottlenecks and food shortages at the worst possible time. The farming industry has been hit hard by the war and the political reaction in Russia to Western sanctions. Russia was the world's top exporter of fertilizers in 2019, according to data from the Observatory of Economic Complexity, when Russia's trade volume in fertilizer stood at nearly $9 billion. Russia and neighboring Belarus, which has also been hit by sanctions, are key exporters of several critical fertilizer compounds, including urea and potash, but curtailed exports of these products has caused prices to soar. Surging fertilizer prices have also been aggravated by higher costs of natural gas, a critical feedstock in producing nitrogen-based fertilizer. Amid a U.S. ban of Russian oil imports and discussions in Europe to decouple from Russian energy, international shipping companies have largely suspended their activity in Russia, bringing global trade to a standstill. And in early March, Russian officials told fertilizer producers in the country to slow their exports in retaliation to Western sanctions. The soaring costs of fertilizers and other key agricultural commodities like wheat used for cow feed could have knock-on effects throughout the world. High prices might lead to severe bottlenecks, severely reducing agricultural production and aggravating what economists have already designated as a global food crisis. Before the invasion of Ukraine, the UN's Food and Agriculture Organization had already warned that acute food insecurity was plaguing dozens of countries spanning Latin America, Central Africa, and the Middle East and Central Asia due to conflict and erratic environmental conditions. The economic fallout of the Ukraine war could further add to that insecurity. Quote, Ukraine has only compounded a catastrophe on top of a catastrophe, end quote, David M. Beasley, executive director of the UN World Food Program, recently told the New York Times, adding that current levels of food insecurity have not been seen since World War II. The effects of trapped food products in Ukraine and Russia, both of which are global bread baskets, are being felt in the world's most vulnerable countries. Around 40% of Ukraine's wheat and corn exports are intended for the Middle East and Africa, according to the UN International Fund for Agricultural Development, which has expressed concern over how massive price swings for stable crops could affect stability in the region. Quote, I'm deeply concerned that the violent conflict in Ukraine, already a catastrophe for those directly involved, would also be a tragedy for the world's poorest people living in rural areas who cannot absorb the price hikes of staple foods and farming inputs that will result from disruptions to global trade, end quote, said Gilbert F. Hungbo, president of IFAD. We are already seeing price hikes, and this could be an escalation of hunger and poverty with dire implications for global stability, end quote, Hungbo said. Brazil, the world's largest importer of fertilizers, was already expecting low crop yields this year due to an ongoing drought, and now scrambling to increase domestic production of fertilizer production as it looks to plug the gap left by Russia. Large producers may be able to weather the storm of higher fertilizer prices, but smallholder and family-run farms who cannot afford higher costs can be hit hard by the market volatility of these key products. Sven Tor Holstetter, the CEO and president of Norwegian fertilizer giant Yara International, told Fortune last November's COP26 climate conference. Natural gas prices were spiking last fall as demand roared back despite low inventory, causing a surge in fertilizer prices. Quote, I'm afraid we're going to have a food crisis, end quote, Holstetter said at the time. So that's not good. So what I've been recommending to everybody is stock up on some non-perishables, whether or not it's those, 30 days of food that, those prepper kind of things. I'm not that kind of a guy. I just bought a bunch of beans and rice, stacked them up in my storage area here in the basement. And if I never have to use them, I don't care, but if the world falls apart and, we start having supply chain problems and a lot of breakdown in civilization, I'm going to eat well. I'll have to walk a little ways to go over to the stream to get some water. But, even without power and electricity, I still have a grill and I can make fire. We have plenty of trees here to make firewood. So that's, I have plenty on the ground. So I probably have 6 months worth of firewood just sitting on my property. So anyways, all right. Last article here has to do with retirement planning. I figured this might be interesting to some of y'all out there. So it's titled, How Long Will $600,000 Last in Retirement? Written by Rebecca Lake. All right. Can you retire with $600,000? It's possible to retire $600,000 in savings with careful planning, but it's important to consider how long your money will last. Whether you can successfully retire with $600,000 can depend on a number of factors, including your desired retirement age, estimated retirement budget, expected longevity, total savings, and income. The earlier you retire, the longer your retirement savings has to last, especially if you have a longer life expectancy. And the type of lifestyle you choose can influence how far $600,000 will go in retirement. Things like inflation and market volatility can also affect your overall retirement outcomes. Health can play a part, as well as healthcare costs tend to increase as you get older. Retiring at 62 may be your goal, but can you do it with $600,000 in savings? If you plan to downsize your home, live a minimalist lifestyle, and supplement your retirement savings with a pension plan, annuity, or Social Security benefits, then the answer may be yes. I don't know if I'd be holding on for Social Security. Unless something is done and the idiots in Washington actually stop spending so much money, that's going to run out. On the other hand, retiring at 62 with $600,000 may not be realistic if you plan to spend more to fund your lifestyle, or you don't have alternative sources of income other than savings. While Social Security benefits can provide income, taking those benefits at 62 will reduce the amount you receive. You'll have to wait until full retirement age, typically 66 or 67, to get the full benefit amount. And you can increase your benefit if you're able to hold out until age 70. It's also important to consider overall health and how that can impact your retirement plans. If you manage to stay healthy and never need long-term care, then $600,000 could be enough to sustain you in retirement. On the other hand, if you need long-term care in a nursing facility, that could take a large bite out of your savings. Medicare doesn't cover extended nursing home care. Medicaid can, but you may need to spend down the majority of your assets first to qualify. Setting up a Medicaid Assist Protection Trust can allow you to get around this requirement, which may be something worth discussing with a financial advisor. So let's apply this to a real life example. Say you plan to retire at 62 with 600,000 saved. You can expect to withdraw 4% each year, starting with 24,000 withdrawal in year one. Your money earns a 5% annual rate of return while inflation stays at 2.9%. Based on those numbers, 600,000 would last you 30 years in retirement. In fact, at age 92, you would still have over 116,000 in savings. Now assume that inflation increases to 4%. In that scenario, you would run out of money by age 90. This is important to understand because rising prices can reduce your purchasing power over time. This is where it becomes helpful to consider other sources of income for retirement, such as Social Security benefits or a pension if you have one. Again, Social Security benefits can begin as early as age 62, but you'll get a lower amount than you would if you waited until full retirement age. But if you're retiring with 600,000 in savings, taking benefits early could make sense if you're worried about running out of money based on your anticipated life expectancy. Using a Social Security retirement calculator can help you get a better idea of how much money you'd like to receive. I know back in the old days, what I would do, this is back in the aughts, I would, run 3 different calculations. If you were to, start taking money at 62, at, full retirement age, or at age 70, and I've, just fill out an Excel spreadsheet, drag it down, and, so we could then see what the break even points were. If someone has a long life expectancy, they're in perfect health, for someone in their 50s or 60s, we would then evaluate. Does it make sense to wait until age 70 and collect the higher amounts? At what age would you break even? Would it be, say 10 years, 15 years, versus, taking the money immediately and getting a lower payout, but, you get less money over time. So, if you're interested in retiring with 600,000 savings, planning early is important. You'll need to consider what age you plan to retire and what kind of lifestyle you anticipate having in retirement and what total savings and income picture will look like. This includes planning for future income needs for your spouse as well if you're married. The earlier you begin saving, the easier it may be to reach your $600,000 goal. So if you have a 401k at work, for instance, you may want to focus on maxing out that account first. At the very least, it's important to save enough to qualify for full employer match if there is one. If you don't have a 401k, you can still save in an individual retirement account. A traditional IRA can offer a tax-deductible contributions with taxes on earnings deferred until you retire. A Roth IRA offers no deduction, but qualified withdrawals are tax-free. A SEP or simple IRA could make sense if you're self-employed. These accounts have higher annual contribution limits than traditional Roth IRAs, so you can save more for the future. In terms of how withdrawals are taxed, they follow the same rules as traditional IRAs. You may also consider creating an additional income stream for yourself with an annuity. An annuity, it's more like an ad here. So, all right. So that's basically it. So it can be done. You don't have to be a bazillionaire to be able to retire. Just having a nice sizable nest egg, can provide a good income stream, but, you have to be able to live within a budget. And sometimes that can be hard for folks. So that's, where someone like myself comes in, helping people stick to, their savings plan or their withdrawal strategy over time. And then also, starting early, whether or not your 20s or your 30s, getting a jump on everyone else and building up a nest egg, sooner than later so that, you can survive the ups and downs of the market. And you can also be able to plan much better as opposed to having to, pour a ton of money into retirement in your 50s and 60s, trying to play catch up. So, all right. Well, that's everything I had today. So if anyone needs anything from me, don't hesitate to reach out. You can go to dsafinancialgroup.com. All my contact information is there if you'd like to book a meeting or you just would like to send me a question. I'll be back tomorrow with Wednesday's Liberty Call, and I hope everyone has a fantastic night. Bye-bye.